About that case that we were talking about, I have an issue with the clients. She's built her wealth. We have it ready to go into a trust, but she has some additional money that we just don't know what to do with. Do you have any suggestions?
Well, it depends on the client's situation. If she's looking to take income from the trust, maybe a portfolio of tax-free bonds, maybe something that she can look at. Another way to secure income is to look at government bonds. With what's going on in the world now in the economy, she may want to lean towards the safe side. Maybe look for something that's highly rated, either backed by the government or maybe by a AAA entity. That would make some sense for her.
Well, what about, do you suggest, she has built a bit of money over the time. I don't necessarily think I need to get her all that much income. I kind of want to do more of a retirement, not so much retirement, but I want to plan it for the children so they can take over.
Gotcha.
So I'm going to set up one trust that's going to focus more on the inheritance aspect. What kind of vehicles would you recommend with that?
I would probably look at everything that she has, put together a comprehensive plan, looking at what she's looking to accomplish for her children, looking at the age of the children, and maybe a portfolio that is going to be a mix of both growth as well as income. For instance, for most individuals that are, let's say, moderate investor, not aggressive, not conservative, just looking at their age, that should be the amount, the percentage that should be in, let's say, safe investments, which we talked about, bonds, CDs, cash. The other half, let's say a 50-year-old, 50 would be in safe, 50% would be into something that can show her long-term growth over time. And it may be a diversified basket of mutual funds, maybe blue chip stocks, something that's going to keep the estate growing and keep them ahead of inflation.
Well, how do you deal with a client or somebody like myself who's ultra conservative and I don't want to go risky? Do you encourage? Do you set it up? How do you explain to me that a little risk is good even though I'm going to be like a no, conservative?
One of the things we do, we sit down with the client and we let them know what risks are involved with each asset class.
Right.
Equity obviously has the best long-term return, but also have the most volatility. When we set up a portfolio, we show them what the best case, worst case scenario is over a time frame, maybe 10 years, maybe 20 years. So this way that they know if they can stomach a certain amount of volatility and they take a longer-term approach, that's usually one of the best ways to explain to a client, because having everything in ultra safe, especially now with the very low rates that are out there, CDs are paying anywhere between 2 to 3%. Inflation is about 2 or 3%. You might wind up with a portfolio that's just keeping you status quo without showing any growth over the long term.
With the economy being the way it is, what's the most common question you're faced with from clients? I mean, is I know from talking to people out there, they don't know whether they should step into the market now, wait, hold their money, or take advantage of some opportunities.
Put it under their pillow.
Yeah.
Keep it in a pillowcase, or go shopping, bargain hunting.
All of the above. All of the above would be the correct answer. A lot of folks, they look at the television, they look at the media, they hear advice from all different areas, and it's almost they're being whipsawed. They're looking at what's happening on the market on a day-to-day basis, and as a certified financial planner, what we usually recommend is just take a long-term approach. Since 1944, we've been through 11 recessions, and we're going through one now.
I didn't think we've been through that many.
We've gotten through 11 recessions.
Right, exactly.
Yeah. So if you take a longer-term approach, make sure that the investments that you're making now, not because you want to buy and sell today, but the real reason why you're investing rather is to retire over the long term, to leave a legacy for the children, to maybe even help your children's children. If you focus on that and you line your investment portfolio with the right type of investments over the long term, and you look at the long-term results, not just what happened over the last year and a half with the bear market, but what the long-term returns has been over the last 60, 80, 100 years, you want to align that to those goals. No one just invests just to invest. People invest for a reason.
So do you preach things like dollar cost averaging?
Yes. That's a great tool, especially during an uncertain time. you want to make sure that you put a certain budget around, and you want to put monies in equally throughout maybe 6 months, 9 months. So this way you dollar cost average in, rather if the market is down or up. So at the end of the investment term, you wind up with a good average price, because we do think that we're going to make it past this recession. There's a lot of companies that are out there that are doing well even during this time.
Right.
And when things turn around, rather later on this year or early next year, those who are getting involved now are going to look back and say, wow, we really got in at some really undervalued or reasonable points.
So what you're saying is that even in today's economy, being a little risky is good.
I think there's a certain amount that you can put into the equities market now, regardless of your age, especially if you're looking at a situation where individuals saving for the children.
Mm-hmm.
You need some type of growth component in your portfolio.
I'm just thinking, you say risky, and I'm thinking it might be the person who's actually investing today might consider himself prudent.
Mm-hmm.
Somebody may say it's too risky to invest today, and somebody else may say this is a great opportunity. I know 10 years from now, this stock that was 80 and is now 25 is going to be back up at, wherever it goes, because that product, we've talked about GE. Light bulbs are light bulbs, and we're going to need light bulbs, 5 years from now, 10 years from now.
Yeah.
And where's GE now?
Around a little over $10 a share.
Which is?
Yeah.
Which is probably low.
Yeah,
How many times the earnings ratio is?
If you look at General Electric, historically is trading at an all-time low now in just above $10 or the single-digit range. So you have a very, very good point, John. I think individuals with a long-term time horizon should commit a portion of their portfolio into equities. Because over the long term, last 100 years, there's really been nowhere else you could see the returns from the equity market. If you're getting involved with blue chip companies with strong balance sheets, companies that make products and services that we all need.
Right.
Again.
And I think that whenever something like this happens to the economy, there are always going to be people that can capitalize on it and make a lot of money in the future. There are people out there that are hunting for properties, because the mortgage rates are low, the properties are, the values are deflated, the foreclosures. Scoop them up, buy them, stock pick your bargains, and then know that 10 years from now, you're probably going to be sitting pretty.
Absolutely. And the toughest decision now, Aaron, you mentioned, is to advise a client to get involved with some equities or to get involved with something that looks risky due to the economic condition that we're in. But if you look at the long term, these are the same assets that coming out of a recession, that's going to show the best possible return. So it makes a lot of sense. It makes a lot of sense.
When you meet with a client to discuss estate planning, at what point do you decide to bring in a financial planner?
Usually when we do the estate plan, it's a confidential questionnaire. When we start hitting on all their assets, and we start looking at, what do they have in the bank? What do they have in the bank? What do they have in bonds? Do they have any annuities and that? And a lot of times you'll get people who just have bank accounts, and all they have is bank accounts, and maybe they'll have CDs, and that's the most planning that they've done.
Right.
At that point in time, that's when we recommend the financial planner to come in, because that's where they do need to start setting things up. And it works for us, too, because it allows us more ability when we're trying to help them shift assets if they're doing certain kind of breakup trust and things of that nature. It allows us to help them more when the planner's coming in making the recommendations based on the assets that they have.
So do you find that generally they need to be educated on the need?
I think everybody needs to be educated. I think even people who are savvy, there are certain areas that they don't know. Some may be really good at dealing with bonds or maybe stocks, but someone may not know anything about annuities. So I think everybody needs some education, and that's why I think estate planning and financial planning really do go hand in hand when you put it together.
Kevin, how about you?
Absolutely.
When you're sitting with a client, when do you recognize the need for estate planning?
Usually when a client comes in, we really survey them. What are their short-term, medium-term, and long-term goals? And as we're taking a survey and we put together a financial criteria for them, we ask them, well, what have you done in a way of estate plan? Do you have a will? A lot of folks mentioned that they do have something in place, but it may be drafted 10 years ago.
Outdated?
Yeah.
Times have changed. Their lives have changed.
Absolutely.
People have changed.
People have changed.
People have come and
Children
gone.
have grown.
Children have grown, and additions to the family. So that's when we usually get a hold of Amory and recommend them to work with a qualified estate attorney who really understand what their needs are.